Everyone is trying to label what just happened, and that instinct is understandable, because humans need names for chaos. Crash, collapse, meltdown, black swan. But naming it too quickly is how you misunderstand it. What just hit gold, silver, and crypto was not a failure of belief. It was a failure of leverage. $15 trillion didn't get erased because the world suddenly decided these assets were worthless. That's not how markets of this size move. That kind of damage only happens when exposure is forced out of the system faster than liquidity can absorb it. This was pressure finding an exit. Silver losing nearly 40%, gold dropping double digits, and crypto seeing one of the largest liquidation events in its history all within the same window is not coincidence. These markets are linked by the same invisible thread: margin. When margin tightens, everything connected to it convulses. The mistake most people make is assuming markets move because opinions change. They don't. They move because balance sheets break. In the days leading up to this move, leverage had quietly reached extreme levels. Futures, options, perpetual swaps, structured products, all stacked on top of each other in an environment where liquidity was already thinning. That structure works beautifully when price drifts higher. It becomes lethal the moment volatility returns. Once price starts moving against leverage, the system doesn't negotiate. It liquidates. That's why the selling felt relentless. Stops were hit not because traders lost conviction, but because they lost permission to stay in the trade. Collateral requirements rose. Margins were called. Risk desks stepped in. Positions were closed regardless of outlook. That process feeds on itself until there's nothing left to unwind. This is how air pockets form. In silver, paper volume exploded to levels that dwarf physical reality. In crypto, billions in long positions were erased in hours. In gold, futures were dumped into thin liquidity. None of this required new information. It required friction. And friction is exactly what appears when confidence in liquidity disappears. Now here's the part most people get wrong. They assume this means something is fundamentally broken. But fundamentals don't change in hours. Supply chains don't rewire overnight. Demand doesn't vanish because a chart turns red. What changed was the tolerance for leverage. That distinction matters because it defines what comes next. In true market breakdowns, sellers emerge everywhere. Physical markets crack, inventories swell, premiums collapse. In this event, physical markets did not behave that way. Holders didn't rush to sell. Real supply didn't flood back. The selling was concentrated where leverage lives. That tells you the stress was financial, not industrial. Crypto shows the same pattern. Long-term holders didn't disappear. What disappeared were highly leveraged positions that were structurally incapable of surviving volatility. Once those positions are cleared, the character of the market changes, even if price remains unstable. This is why the aftermath of liquidation events is so confusing. Price stops collapsing, but it doesn't immediately recover either. The market enters a no-man's land where fear lingers, volume fades, and conviction is scarce. That phase feels uncomfortable because it offers no narrative resolution, but that phase is where structure resets. Another layer here is psychology. Extreme moves exhaust people. After a shock like this, participation drops. Traders step back. Investors hesitate. That reduction in activity actually makes the market more sensitive to new flows. Once leverage is gone, it takes far less buying to move price. That's why rebounds after liquidation events often feel disproportionate and sudden. Not because sentiment flipped overnight, but because resistance disappeared. Now add the macro backdrop. Liquidity is not abundant. Funding is not cheap. Confidence in institutions is fragile. The first bank failure of the year didn't cause this event, but it contributes to the environment that makes leverage dangerous. When counterparty risk re-enters the conversation, the appetite for exposure changes. Geopolitical tension adds another layer. When uncertainty rises, the first instinct is not safety. It's liquidity. People sell what they can to raise cash. That's why safe haven assets often fall first. The flight to safety comes later, after the forced selling phase is complete. That sequencing is critical. Phase 1 is liquidation. Phase 2 is repricing. Most people confuse the two and assume phase 1 invalidates the entire thesis. It doesn't. It resets it. This doesn't mean the risk is gone. Volatility can persist. Additional margin increases can force more selling. Liquidity events can come in waves. Anyone using leverage right now is operating inside a hostile environment. But hostility is not the same as collapse. What we just saw was the system shedding excess. Excess leverage. Excess confidence. Excess positioning. The question now is not whether the move was extreme. It was. The question is whether it solved the underlying tension or simply exposed it. And exposure always changes behavior. Markets don't die when prices fall. They die when participation disappears permanently. That's not what this looks like. This looks like a system recalibrating under stress. What comes next will depend on whether forced selling resumes or fails, whether physical markets soften or remain tight, whether leverage rebuilds too quickly or stays restrained. But one thing is already clear. This was not random. It was not sentiment-driven. It was mechanical. And mechanical moves tend to reverse faster than people expect once the machine finishes doing its work. After a liquidation wave of this magnitude, the market doesn't rush to reassure anyone. It does the opposite. It becomes quiet, uneven, and psychologically exhausting. Price stops collapsing, but it doesn't give clarity either. That uncertainty is not accidental. It's the natural state of a system that has just purged excess leverage and is recalibrating risk. What matters now is not the speed of the rebound, but the behavior underneath it. Liquidation-driven crashes change who is left in the market. The participants who remain are not the ones chasing momentum or running high leverage. They're the ones who can tolerate volatility or who were underexposed to begin with. That shift alone alters the way price responds to demand. This is why markets often feel fragile after the worst appears to be over. Volume dries up. Every move feels suspicious. Confidence is low. But structurally, the market is healthier than it was at the peak because the weakest links have already snapped. In metals, this shows up through physical flow. When price collapses but real supply doesn't come back to market, it means holders are not panicking. That creates latent pressure. Price can hover or drift lower for a while, but the absence of supply becomes increasingly relevant as time passes. In crypto, the parallel is derivatives activity. After major liquidations, open interest resets, funding rates normalize, the market becomes less sensitive to small price moves and more responsive to real buying. That transition doesn't make headlines, but it changes the entire dynamic. This is where patience becomes a competitive advantage. Most participants are conditioned to react, not observe. They expect either continuation or reversal. When neither arrives cleanly, they disengage. That disengagement is part of the reset. It reduces noise and allows real positioning to rebuild without resistance. Another important factor is that liquidity crises rarely resolve in a straight line. Stress can resurface. Headlines can trigger new waves of selling. That doesn't negate the structural shift that has already occurred. It simply reflects how fragile confidence remains. The mistake is assuming that volatility equals danger and calm equals safety. In reality, volatility often marks the clearing process, while calm hides the buildup of imbalances. What we just saw was imbalance being exposed, not created. Once leverage is gone, markets don't need optimism to move higher. They need marginal demand. And marginal demand appears quietly, not in a rush. It shows up when price stops responding to fear and starts responding to absence of supply. That's why the next phase often surprises people. Price moves without obvious catalysts. Pullbacks fail. Rallies feel unearned. Participants chase strength reluctantly because they're anchored to recent pain. By the time confidence returns, the opportunity has already passed. This does not mean every asset will recover equally. Differentiation matters. Quality matters. Balance sheets matter. Markets that rely purely on narrative struggle longer than markets grounded in real demand. That sorting process happens after liquidation, not before it. Macro conditions will continue to matter. Banking stress, geopolitical uncertainty, and policy decisions will influence liquidity and risk appetite. None of those forces disappeared because price fell. They remain part of the environment and will shape how capital allocates next. The key distinction is this. What just happened was not a verdict on gold, silver, or crypto. It was a verdict on leverage. And verdicts on leverage are often the first step toward more sustainable price discovery. When people say everything is broken, they're usually reacting to speed, not substance. Broken systems fail slowly. They grind, they decay. This system snapped back violently because it was stretched too far in one direction. Violence in markets is rarely random. It's a release, and releases change the slope of the road ahead. Whether this moment becomes the foundation for a rebound or a waypoint in a deeper crisis will depend on how liquidity behaves from here. But one thing is already true. The market is no longer carrying the same excess it was before the crash. That alone changes the probabilities. The goal now is not prediction, it's interpretation. Watch what price does when fear fades. Watch whether supply appears or stays hidden. Watch how quickly leverage rebuilds. Those signals will tell you far more than any headline ever will, because in markets, the most important moves are not the ones that shock you. They're the ones that happen after the shock, when everyone is too exhausted to pay attention.